Hi, Larry Gaines, PowerCycleTrading.com. In this video, I want to show you a earnings double calendar spread. Okay, so we're right in the midst of earnings season, lots of earnings season, lots of trades and stuff, and a lot of high implied volatility. So when we have expanded volatility, one trade setup is to sell volatility. So we can do that with a lot of different strategies, but one of my favorites is using what we call the double calendar spread. So this is one that is a non-directional trade, and so it doesn't really matter what direction. We're just going to look to sell volatility. So here's how it works. Let me walk you through it. This is one that we set up on Microsoft that had released its earnings on the 27th, right after the close. So the first step, with any trade is to look at the data. Okay, so we want to look for high probability type trades. So I like to look back at prior or past earnings history. So with Microsoft, the implied move over the past 4 or 5 cycles or earnings seasons has been around a little over 4%. Let's average it out to 4. And then what I do is I want to see, okay, where did it actually close at expiration? So if you look at Microsoft down here, so this its earnings was on Tuesday after the close, and so this would be like a Friday expiration. So you can see that Microsoft over the last 1, 2, 3, 4, 5, 6 earnings seasons has had a close up or down below, the biggest was a big move of 4.94%, but typically it's within the expected move here. So 4.5%, 5%, typically it trades inside of that. So we're going to set up a double calendar here to sell volatility to take advantage of this expected move range. So this trade was going to be set up at 4% for up or down on the calendar. So let me walk you through that. So the first thing is also to look at the implied volatility. So here's Microsoft. This was Microsoft on the 27th going into the close on Tuesday. So you can see the implied volatility where my pointer is was 55.63%. And typically, you can see the week behind it was 48.3. So we call this horizontal volatility skew positive. Okay, so if you look right here, this 205 strike, we're going to do a calendar and we're going to target the 205 on the put calendar. You can see the implied volatility is 52.36, and then behind it, the next series, the 6 November, is 46.54. All right, so this is higher volatility. So we want to sell that and buy that lower volatility. Now we were going to do the 220 strike for the call calendar, and you can see where my pointer is. This prior prompt week, the 30 October, is 52.23% implied volatility, and the week behind it that we would buy is 46. So that's positive skew. So we're going to sell this 30 October series, buy the 6 November series against it. So that's one advantage. And the other advantage is theta. Okay, we're going to have theta decay that's going to be higher in the 30 October series than the 6. Okay, so we get that positive differential as well. So here's the theta values. So this is for the 205 put that we're going to sell short. It's got a theta decay of about 46 cents per day. The 205 put that we would go long has theta decay of 28. So we have that positive differential on theta, so we get more advantage of selling this front 30 October series. We get a greater theta decay than the one that we buy. And also then on the 220 strike, you can see it's right here 52 cents and then 30. So we get that 5 worth about 22 cents of theta. All right, so here's the trade setup. So the expected move for Microsoft was to go up 4.5% or down 4.5%. So what I like to usually do is set, this is kind of like the target right here would be that 4% up, 4% down. So I typically set it just right at the expected move or a little bit inside. So what we did was we did a call calendar. So where my pointer, we bought 6 November 222 and a half call, and then sold the 30 October against it, the 222 and a half call here. So we did that as a spread of $1.65. All right, so the max risk is $165 per spread, and then we targeted, so that's the call calendar right here, and then that's 4% up, and then we targeted 4% down doing a put calendar, the 205. So we bought the November 6 205 put, sold the 30 October 205 against it for $1.75. So total at risk is the debit spread cost of these two spreads, which is $340. Now yesterday on the 28th, the market collapsed hard, and when it was trading down at $24.79, this trade was up over $100, $108, so about 31%. So, but today, let's take a look at it currently. So here it is today on the 30th, Thursday, and it's trading at 204.59. So it's up about $92 per spread. So the 106, this 6 November, 30 October call side of the calendar is, dropped in value to 53, but the put calendar, the 205, is up in value from 1 175 to 370. All right, so up $90 per spread. The thing that's great about the double calendar is that your break evens are so far out. So for this to break even to the upside on Friday, it'd have to go, it'd have to trade above 226, or to break even to the downside, it'd have to trade below about 200. All right, so that's way out of the money. Now tomorrow, it has even more potential. If I put this to my analytics, I'll show you tomorrow. And if tomorrow it's going out right here at this level where it's currently trading at 204.70, then this trade will be up. It'll be up here. The max potential profit, it could be up over 150 if it's trading down here at that 204, 205. So that's the double calendar. It takes advantage of selling volatility and time. And if you'd like to learn more about these types of trades and other option strategies, make sure to check us out at powercycletrading.com. Good luck trading.